In the summer of 1720, the air in London's Exchange Alley was thick with the scent of coffee and desperation. Men who owned half of England stood shoulder to shoulder with shopkeepers and domestic servants. They were all there for the same reason, a piece of paper, specifically a share in the South Sea Company. At the start of the year, a single share cost about £128. By June, that same share was trading for nearly £1,000. There was no new gold found, no new land conquered, and not a single ship had returned with the riches everyone whispered about. It was a mountain built of nothing but belief. To understand how a sensible nation lost its collective mind, we have to look at the problem the British government was facing. Britain had spent the last few decades fighting the War of the Spanish Succession. It was a global conflict, and like all global conflicts, it was ruinously expensive. By 1711, the government was drowning in debt, roughly £9 million of it. In today's terms, that is a figure that defies easy translation. But at the time, it threatened the very stability of the monarchy. The government needed a way out, and a group of merchants and politicians led by a man named John Blunt offered a solution. They proposed a private company that would take over the government's debt. In exchange, the government would pay the company interest and grant them a monopoly on all trade with the South Seas, what we now call South America. There was just one problem. Spain controlled South America. The monopoly was essentially a license to trade in ports where British ships weren't allowed to dock. But in the coffee houses of London, reality mattered less than the narrative. The South Sea Company wasn't just a trading firm, it was a financial engine. They weren't selling spices or gold. They were selling the idea of future wealth. By 1719, the directors of the company saw an opportunity to go bigger. They proposed taking over the entire national debt, over £30 million. To do this, they needed to persuade people who held government annuities to swap them for shares in the South Sea Company. To make that swap attractive, the price of the shares had to go up. This is where the architecture of the bubble began. The directors didn't just wait for the market to move. They pushed it. They offered bribes to members of parliament in the form of options on stock. They spread rumors of peace treaties that would open up the gold mines of Peru. They created a feedback loop where the rising price of the stock became the primary reason to buy the stock. As the price climbed through the spring of 1720, a strange phenomenon took hold. It wasn't just the wealthy who were buying in. The moneyed interest was joined by the middling sort. People sold their homes, their businesses, and their family heirlooms to get into the market. It felt like a new era where poverty had been solved by the stroke of a pen. Even Isaac Newton, perhaps the most rational mind in human history, succumbed. He initially invested, made a handsome profit, and sold his shares. But as he watched his friends continue to get richer, he couldn't stay away. He jumped back in at the very peak. He would later famously remark, "I can calculate the motions of the heavenly bodies, but not the madness of people." The frenzy reached a point where bubble companies began to pop up every day. These were fraudulent startups riding the coattails of the South Sea excitement. One company famously advertised itself as a company for carrying on an undertaking of great advantage, but nobody to know what it is. People lined up to give them money anyway. The South Sea directors, ironically, were the ones who popped the bubble. They were worried that these smaller fraudulent companies were taking money out of the market that should be going into South Sea shares. They lobbied Parliament to pass the Bubble Act, which made it illegal to form a company without a royal charter. They got their law, but in doing so, they signaled to the public that the market was full of fraud. Panic, once it starts, is impossible to throttle. People began to look at their South Sea shares and realize that the company still hadn't sent a single successful trading expedition to South America. The great advantage was a ghost. In August 1720, the price began to flicker. By September, it was in freefall. The £1,000 shares crashed to 800, then 500, then 200. By December, they were back where they started. The aftermath was a landscape of total ruin. Suicide became a daily occurrence in the city. Members of Parliament were dragged from their homes by angry mobs. The Chancellor of the Exchequer was sent to the Tower of London. The wealth of a generation had vanished, not because the money was gone, but because the illusion of its value had evaporated. But the most significant part of the story isn't the crash itself. It's how the system survived it, and the quiet, structural changes that followed which still dictate how our modern financial world operates. When the dust settled in the winter of 1720, the British government faced a terrifying reality. The people's trust in the state was as decimated as their savings. If the government allowed the financial system to stay broken, the monarchy itself was at risk of following the stock price into oblivion. To fix it, they turned to a man who had been one of the few voices of caution during the mania: Robert Walpole. Walpole's task was essentially the world's first major corporate bailout. He didn't just need to find money, he needed to restore the concept of credibility. He divided the South Sea Company's remaining assets between the Bank of England and the East India Company. He didn't try to bring the old prices back. That was impossible. Instead, he stabilized the floor so the country could stop falling. In doing so, he became Britain's first prime minister in all but name, establishing a political office born directly out of a financial crisis. This stabilization came at a steep human cost. The sinking fund, designed to pay off the national debt, became a permanent fixture of British life. Taxes on everyday items, salt, candles, beer, stayed high to service the interest on the debt that the South Sea Company had failed to erase. The elite had gambled, the system had buckled, and for the next century, the ordinary citizen paid the bill in increments so small they almost didn't notice. Perhaps the most enduring legacy of 1720 was the psychological scar it left on the global West. For nearly 100 years afterward, the Bubble Act made it extremely difficult to form a joint stock company in England. The very idea of a corporation, an entity where many people pool their money for a common goal, was viewed with deep suspicion. It slowed industrial progress, but it created a culture of extreme caution. It taught the world that value is not a physical law like gravity. It is a social contract. We often look back at the people of 1720 and wonder how they could be so foolish. How could they believe in a company that had no ships? How could they buy into a company for an undertaking no one shall know? But if we look closer, we see the same patterns in our own lives. We see the same rush toward new paradigms, where old rules of math supposedly no longer apply. The South Sea Bubble wasn't a failure of intelligence, it was a failure of memory. The investors in Exchange Alley weren't stupid. They were simply convinced that they were living in a unique moment in history where the old burdens of debt and labor had been solved by financial engineering. Today, our systems are faster and our markets are global, but the architecture of the 1720 crash remains visible. We still deal with too-big-to-fail institutions. We still see the government step in to socialize losses after private gains evaporate. And we still see that familiar transition from the moneyed interest to the middling sort right before a market turns. The lesson London learned the hard way is that when a financial system becomes more about the trade of the paper than the value of the work, a countdown begins. The tragedy of the South Sea Bubble isn't that it happened once, it's that it provided the blueprint for every once-in-a-lifetime crisis that has followed it. The elite of 1720 eventually moved on. The estates were sold, the names in Parliament changed, and the coffee houses in Exchange Alley eventually closed their doors. But the debt stayed. It always stays. It just changes hands, moving from the ledgers of the powerful to the daily lives of the many, where it quietly shapes the world we live in today.